Welcome to the Opening Bell Report.
Okay, just imagine this for a second. You wake up, you grab your coffee, and you pull up your watch list.
The morning ritual.
Exactly. And on that list is a stock, ticker VERO. Yesterday it was just sitting there at, what, $1.44?
Yeah, basically a penny stock. Just
Right.
another name drifting towards zero.
Totally boring.
Yeah.
But this morning, you look at the screen and you genuinely think your computer is broken.
You think it's a data glitch.
100%. Because that $1 stock is suddenly trading at nearly $13.
Yeah.
I mean, that is a 450% surge in a single day.
That's the kind of move that just, it doesn't seem real. It can make fortunes and, destroy them in the same breath.
And just as you're trying to process this, the market closes. And in after-hours trading, the bottom just falls out at 28% drop instantly.
Total whiplash. It's pure chaos.
So you've got the bears online screaming, "See, it's over," and the bulls are all yelling, "Buy the dip."
Right. It's a frenzy.
But look, we are not here today just to stare at a crazy chart. Anyone can do that.
No, we're here to get into the mechanics behind the chart, because these things don't happen by accident.
We are doing a deep dive on an analysis report covering Venus Concept, that's VERO. And honestly, this isn't really a story about their products, is it?
Not at all.
Yeah.
No, if you're hoping to hear about medical aesthetics, you're in the wrong place. This is a case study in market structure.
It's about what happens when the plumbing of the stock market just completely breaks.
Mm.
The report we're using, it breaks down the SEC filings to show exactly why this happened. And the answer is just, it's wilder than I thought.
It's all about supply, or really, the lack of it.
So our mission today is pretty simple. By the end of this, you are going to understand what a supply shock is, how what we call smart money really operates.
And how to read between the lines of a hostile takeover.
It's time to dig in.
Let's do it.
So when I see a stock jump 450%, my first thought, and I think it's true for most people listening, is the internet.
The usual suspects, yeah. A Reddit army.
Right. I'm thinking, okay, which Wall Street Bets forum found this? Is there a Discord group pumping it? Has some influencer tweeted a rocket emoji?
And that's a fair assumption. We've been conditioned by GameStop, by AMC. We see a vertical chart, and we just default to thinking it's a meme stock.
Thousands of small traders all buying at once.
But this analysis report we're looking at, it's very clear on this point. It says, stop looking at Reddit. This was not a grassroots movement.
Not the internet.
No. The report calls it a hostile takeover level event. This wasn't driven by thousands of small players. It was one single massive entity,
Whale.
the Leviathan, Modern Asset Management. And the catalyst wasn't a tweet, it was a piece of paperwork, a really important one called a Schedule 13D.
Okay, so I've seen that term, 13D, thrown around.
Yeah.
Break it down for us. What makes it so different from, me just buying some shares?
So if you or I buy stock, nobody really cares. But a 13D,
Yeah.
that's different. You have to file that when you buy more than 5% of a company, and this is the important part. You intend to influence or control the company.
So it's not a passive investment. It's a declaration.
It's a declaration of intent. It's basically telling the board, hi, we're here, and things are about to change. But the thing is, Madryn didn't just buy 5%. They didn't even buy 10 or 20%.
What's the number?
According to this analysis of the filing, Madryn Asset Management now controls 91% of the company.
90.
91%.
Wow. Okay, let's just pause on that. That's not just a big stake. That's ownership. They own the entire company practically.
It is total control. And this is where we get to the core of the whole story, the concept of the public float.
Right. Let's really nail this down because this is the engine that drove that 450% move.
Okay, so think of the total shares as every slice of a pizza, the whole pie. The float is the number of slices that are actually available on the counter for people to buy.
The inventory.
Exactly. But in this case, Madryn didn't just buy a slice. They walked in, bought 91% of the entire pizza, put it in a vault, and walked away.
So the report says the float is razor thin.
It's basically zero. I mean, think about it like a concert with 10,000 seats. Madryn just bought 9,100 of them and locked the doors. They aren't even sitting in them. They just took them off the market.
And now you have thousands of traders outside the arena, all fighting over the last few hundred seats.
That's it. That is the exact mechanic of a supply shock.
So walk us through how that translates into the price going from, $1.50 to $13. Why does that happen just because the shares are locked up?
Well, normally when a stock price goes up, people who own it start to sell. They take profits. That selling pressure acts like a natural brake on the price.
It provides liquidity for the new buyers.
Precisely. But here, you have this massive wave of buyers rushing in. They see the news, they see the momentum, and they're all screaming, buy! But who are they buying from?
There's nobody there to sell to them. Madryn is holding 91% and they're not selling.
Madryn is sitting on their hands, so you have a tidal wave of demand crashing into a brick wall of almost zero supply.
So the price doesn't just climb, it has to jump.
It teleports. The sellers who are asking $2, $3, $5, they're all gone. The next available share for sale might be listed at $10, so the price just gaps straight to 10 because that's the only seat left in the arena.
That's the aha moment. It wasn't that the company's value changed. The business was the same on Tuesday as it was on Monday.
Exactly the same. Same products, same debt, same everything. You weren't paying for value.
You were paying a premium for scarcity.
You've got it. It was a purely mechanical squeeze, supply and demand physics.
Okay, so that explains the rocket launch.
Yeah.
But then, the crash. The report highlights that huge 28% drop after hours.
The hangover. Yeah.
And this is where it gets tricky for me. If the supply is still gone, if Madryn still owns all the shares, why didn't the price just stay at $13?
This is where we have to stop looking at the chart and start reading the fine print in that filing. The analysis calls this the bearish trap.
Okay, lay out the trap.
You have to ask why Madryn bought 91%. It wasn't to day trade it. They aren't trying to flip it for a quick profit.
Right.
The report points to specific language in the 13D filing about delisting and cost reduction.
Delisting. That sounds bad for a shareholder.
It can be. When a firm gets this much control, their goal is often to take the company private.
And why would they do that?
Because being a public company is expensive. You have all these SEC reports, shareholder meetings. It's a hassle. If you want to restructure a broken company, it's way easier to do it behind closed doors, away from public scrutiny.
Okay, so what happens to me if I bought shares at $12 and they take it private?
And that's the trap. They don't just invite you along for the ride. They force a buyout of the remaining shareholders at a price they set.
They just name a price.
Pretty much.
Yeah.
Let's say, just hypothetically, they decide the fair value is $5 a share.
But I paid $12.
Exactly. If they set the buyout at $5 and you're holding a bag you bought at $12, you lose $7 a share instantly. The stock is gone from your account and you get $5 in cash. Game over.
Ouch. That is brutal.
So the smart money, the traders who actually read the filing, they saw the run to 13 and immediately knew Madryn would never pay that much in a buyout.
Oh, they took their profits.
They sold. They dumped their shares into that wave of buying, and that's what caused the after-hours flush. They got out before the music stopped.
Okay, so that's the bearish case. The party ends with a forced buyout at a much lower price. But the analysis report, it doesn't stop there. It pivots to a bullish dip-buy thesis.
Of course, because for every bear, there's a bull, especially when there's this much volatility.
The report says, I know how you guys think. You love volatility. So what's the argument for buying this thing after that big crash?
Well, two things. First, the idea of a buyout premium. Even if Madryn wants to take it private, they usually have to offer a price that's a little higher than where the stock is currently trading.
A sweetener to make everyone go away quietly.
Exactly. To avoid lawsuits and headaches. So if the stock is trading at, say, $5, maybe they offer $7 or $8. So the bet is you buy at $5, hoping for a buyout at $8.
That's one part of the bull case. What's the other?
The other part brings us right back to the physics of the market, the float.
It's still gone. Nothing's changed there.
Nothing has changed. The shares are still locked up, so the potential for another explosive move is still there. It takes very, very little buying pressure to send the price flying again.
It's a tinderbox.
A very dangerous one. That's why the report says for day traders, this is a must-watch ticker. The volatility isn't going away anytime soon.
I love this metaphor the report uses. It calls VERO a gladiator arena.
It's perfect.
Yeah.
This is no longer an investment, it's combat.
Let's break down the two sides in that arena. The report calls it a binary bet.
Yep. On one side, you have the longs, the bulls. They're betting on another squeeze. They're looking at that tiny float and thinking scarcity will win.
And on the other side,
The shorts, the bears. They're betting that the delisting threat is going to kill all momentum and the stock will just bleed out until a low ball offer is made.
a real tug of war. The report gives us a really specific level to watch, a line in the sand.
$5.50.
Why 550? What's so special about that number?
In technical analysis, these levels become psychological battlegrounds. The analysis suggests that 550 is the key support. If the stock stays above it, it means buyers are still interested.
And if it holds?
Then the report suggests you could see a run back up toward $8.
But if it breaks below 550?
Then look out below. That's the signal that the bulls have given up. The floor could drop out and it could head down towards, maybe $3 or $4.
It's amazing how it becomes a self-fulfilling prophecy. Everyone is watching 550, so 550 becomes the most important number.
That's modern trading in a nutshell. Especially for a stock like this, you're trading the psychology of the other traders.
The report ends with some very direct advice. It says, keep stops tight and do not get married to this bag.
That should be written above every trader's monitor. Do not get married to this bag.
Translate that. What does it mean?
It means this is not a long-term investment. Don't fall in love with the story. This is a temporary structural anomaly, a supply shock. Once that situation is resolved, either by buyout or something else, the game is over.
And if you're the one left holding the bag,
You're the one who ends up paying for everyone else's party.
So this whole thing, we started with a chart that looked like a random glitch, a 450% surge. But once you dig in, it's actually brutally logical.
Step-by-step logic. First, the supply shock from the 13D filing sends the price vertical.
Then the smart money realizes the delisting risk and bails, causing the crash.
And now we're in the gladiator arena, watching that 550 level to see who wins the final battle.
It's just a perfect reminder that you have to look past the chart. You have to read the filings.
That's where the real story is. The average person sees a stock moving and asks, what's the news? But sometimes the answer isn't news, it's structure.
It really is. Without reading that report on the 13D, you'd just be guessing. And guessing is a very, very expensive hobby in the market.
The real edge comes from understanding the plumbing.
So here's a thought to leave you with, something I've been thinking about this whole time. In a market where a stock can jump 450% just because the shares aren't available to buy, not because the company's better, not because they invented something new, are you actually trading the company's value anymore? Or are you just trading the mechanics of scarcity itself?
That's the big question, isn't it? Are we investors in businesses, or are we just betting on supply chain glitches in the stock market?
Something to think about. Thanks for diving deep with us today.
Stay sharp out there.
We'll catch you on the next one. Stay curious.
Don't forget to like, share, and subscribe for more.